I'm Brian. If you've ever been confused about percentage rates with respect to investments, let me explain how they work. It could end up saving you quite a bit of money. You need to understand these basic principles, which can be confusing, particularly how they write them online or show you. So I'm going to talk about percentage rates, yield. In other words, you put $1,000 in the bank, you make 10%, you're getting 10% on your money. Maybe you put it into a stock. The stock has a dividend yield. They always say you get this percent, but that's not exactly how it works. And then crypto is even a little more confusing. Before I do that, please subscribe so you can see more of our videos. I talk about how to get out of debt, how to use credit cards to your advantage, and how to invest, diversify, and grow your net worth. And I always appreciate comments if you have them. So let's talk about first cash. This is the easiest. You go to your bank, give them $1,000. They're going to tell you that you're going to get 10%. That's a big number. Probably not what's going to happen. But that ends up being $100. Okay, simple math. Maybe you get a certificate of deposit. And for example, it might say for 6 months. Maybe you get some sort of a treasury bill. All those things are going to be, or a bond, and all those things are going to be just cash and a return. In this case, the $1,000 sitting in a checking account. You'll be able to take the money out at any time. In a CD, you have to lock it up for a certain amount of time. But this is simple, right? You have $1,000 in USD, dollar bills. 10%, what do they give you back? They give you $100 USD. Okay, that is really, really simple. Now let's talk about stocks. So you take $1,000. All right, cash, and you send it to your online brokerage, and they receive it as, $1,000 in cash. And so here's your $1,000 that you sent over to your brokerage. And you say, ooh, I want to buy 10 shares of a stock. It cost $100, so it's $1,000, right? Because you bought 10 shares at $100 each. Let's just assume there's no transaction fees and whatnot. Okay, so your USD in the account is 0. All right, you no longer have any cash in the account. What do you have? You have 10 shares of a stock. Let's say, for sake of argument, just to keep things simple, that these shares, when you look online, it's going to say, oh, you have a 10% yield. But that is misleading. What they're doing is they're calculating the yield. You don't actually get a 10% yield. What you get is a certain amount of earnings per share. You'll see EPS. They're taking that number and they're calculating what it would be based on what you invested. So if you have 10 shares and over the course of a year, they're going to give you $10 per share. Earnings per share, $10. Okay, 10 shares times $10 is $100, right? You invested 1,000. So what is 100 of 1,000? It's 10%. So they say, you are getting a 10% yield. Okay, why is that a little misleading and why do you need to understand earnings per share? Because if, let's say, that your stock goes up in value. All right, so let's do this. Let's just say you're now sitting in your account with your 10 shares. And you get $10 a year in earnings per share. All right. Now, what they pay you out is they pay you 10 shares, $10 over the course of the year, you'll get your $100. You're going to get $100 in US dollars. And this is important when we compare it to crypto. Now, you're thinking to yourself, I got $1,000 is what it cost me. That's what I invested, my $1,000. I got $10, 10 shares, got $100. Okay, got my $100. What is that? That is a 10% yield. Great. I get a 10% yield. Therefore, if my stock goes up and it's now worth $2,000, 10% yield. Ooh, I'm going to get $200. No, you're not. You're not. You're going to get 10 shares times $10, $100. No matter what the share price goes to. So that's where people get confused, right? They're thinking that as this value of the stock goes up, 2,000, 4,000, 8,000, 10,000. So let's use the number of 2,000. Let's say that it were to go up to $2,000. You're going to get $100. Now, you only invested 1,000, and you're getting 100. So you're always getting 10% on the money you invested. But it's worth 2,000 now if you were to sell it. But you're not going to get 10% of 2,000 because you're not getting a percentage rate of what it's worth. You're just getting a certain amount of dollars per share. Okay, why does this matter? So your buddy says, hey, that stock you were telling me about has really been going up. It looks awesome. I'm going to buy some. And you're like, yeah, it's awesome. I'm getting 10% yield. It's fantastic. So he buys it. And he buys 10 shares. And those 10 shares cost him $2,000 because the stock went up. And he gets $10 per share. He also has 10 shares. Right? But since the price went up, you paid $1,000 for it. He paid $2,000. He has 10 shares. He gets his $10 per share. That's $100. He gets $100 in his account. You get $100 in your account. He gets $100 in his account. You paid $1,000. He paid $2,000. Your effective yield on your 1,000 is 10%. His effective yield on 2,000, he got $100, is 5%. So you'll notice when you look at stock prices, you might look one day and it'll say, 10% yield. And then the price starts to go up. A month later, it's gone up a little bit and it says 9% yield. And you say, ooh, the yield went down. I wonder why. Well, it went down because the price went up. What it means is if you buy that stock on that day at that price, based on the earnings per share, that's effectively what you're going to get. Now, before we get to the crypto example, what do you get on your shares? Remember, you don't have $1,000. It's not sitting in your account. You don't have $2,000 in your account. What you have in your brokerage, you have, let's get rid of everything, 10 shares. You converted your cash to shares, but what do they pay you in dividends? When they pay you out, they pay you in US dollars. Now, you'll now have 10 shares, and at the end of that year, you would have $100 in your account. Right? 10 shares and $100. Great. Now, what you can do, and what some people do, is you can say, automatically reinvest my $100 into shares, and it'll buy more shares for you. But of course, at the price for that day. So that's the automatic dividend reinvestment, so you can compound that over time. What's important to note is you're no longer sitting on cash. You're sitting on shares. Why do I say that? Because crypto to me is fascinating. Now, let's say that you take your $1,000, and this is going to look just like the stock example, and you send it over to Coinbase, Crypto.com, you use MetaMask, however you do it, and you buy $1,000 worth of a particular coin, whatever it may be. And you get your, what we use in the other example, 10 coin example, 10 shares. So now we're going to talk about 10 coins. Those coins cost you $100 each, okay? So now you have 0 USD. All right? You took your $1,000 USD cash, you moved it into your account, and just like buying shares, you bought coins, you have no money in your account, but you have 10 coins. Okay, just like you had 10 shares, right? Same thing. How does compounding work? Now, there are ways that you can earn a percent on your coins. Some of it, you can take it out of that earn account, if you will, after a certain amount of time. Sometimes it only takes a couple days. Sometimes you have to lock it up for a period of time. When you lock it up for a period of time, the interest rate, usually that what it states you're going to get is what you're going to get. But here's what's interesting. Just like the stocks, when now the stock were to pay you earnings per share, the interest rate for crypto is not on the cash or what you invested. It's on the coins. But where the stock pays you earnings per share. They pay you in dollars. Crypto pays you in crypto. So here's what's interesting. Let's say that you locked up your 10 coins. Let's get rid of these dollars because you no longer have any money. Haha, shouldn't say money. You no longer have USD or fiat currency. You now have your 10 coins. That's what you got. And it says you locked it up for a period of time, or let's say a year, and you're going to get 10%. So what's 10% of 10 coins? It's 1 coin. Yes, the coins cost you, your cost basis, what you paid, was $1,000. You paid $1,000 for your 10 coins. You get 10% not of $1,000, right? Because that would be $100. And in that case, they put $100 in your account. They're not doing that. They're saying, how many coins do you have? Oh, you have 10? You get 10%, you get 1 coin. So what's interesting about crypto is, let's just assume, now of course crypto can go up, crypto can go down. What's happening here is they're giving you a coin. Let's say that your $1,000 bought you 10 coins, so it was $100 a coin. And you're all happy because you invested $1,000 and you're getting 10%, you're getting a coin, the coin's $100, right? Great. What if the coin goes up in value? And the coin is now $200 a coin. Okay. Well, you might be thinking, well, 10% of 1,000, well, they're just going to give me $100. Well, no, it's 10% of 10 coins, you get a coin. If it was $100 a coin, you'd have $1,000, and you just got a coin for 100. So you do the math, and you say, I got 10% on my investment. That's awesome. But if it's $200, and you invested 1,000, what are you getting back? You're getting back effectively 20%. In cash, if you were to sell that coin. So in your account, you now have, use another color, you now have 11 coins. You invested $1,000. You take that 1 coin you just got, and if you want, you can sell it, turn it into cash, and you got $200. Holy smokes, because you got in return a coin, not cash, it went up in price, and you're going to go ahead and you're going to take that coin and you're going to sell it, and you could get $200. See, in the stock example, it didn't matter if the share price went up. The share price that you bought for $100 a share, it could go to 200, 400, 500, 600, 800. You don't get value because you're not getting a share back. You're getting earnings per share. So remember, here's the main difference between a stock yield and a crypto yield. And the difference is, with the stock, you had invested $1,000. It was $100 a share. It was a yield of, what did we say, the earnings per share, I think I said it was $10. Okay. So, and you have 10 shares. 10 shares. So this is what they're doing. 10 shares, 10. Okay, you get $100. All right. The stock price goes up to $200, $300, $400, $500, $600. Oh my gosh, it's Tesla. It's $1,000. This is crazy. You know how much I'm going to get now? Yeah, $100. Wait, what? Yeah. Doesn't matter that 1,000 times 1,000 is a really big number. What matters is that, $100 a share. Oh, I'm sorry, you only have 10 shares, right? It's $1,000, so it's $10,000. You invested 1,000. You now have $10,000 if you were to sell it. That's great. But what are you getting in return? You're getting $100 because you're getting $10 per share. Now this number can change. They can change it, but it has nothing to do with this. Nothing. So while your investment goes up in price, right? Your investment goes up from 1,000 to 10,000, but your yield is still the same. Now, crypto. What we just showed you was on crypto. You got your 10 coins. They cost you $1,000, right? And you paid $100 a coin, and you got your 10 coins, and you're getting 10% yield on the coins. All right. Now the coins go up in our example to $200, $300, $400. Let's use $1,000.
oh my goodness, you have 10 coins times $1,000, you know, a value of $10,000, right? Just like the stock. The value of the coins went up. But what are you getting as a yield? 10% of 10, which is one coin. But what's a coin worth? $1,000. Your yield, because they're giving you coins, your yield actually grows, meaning it's worth more, meaning you're getting the benefit of the higher coin price. Your yield on a stock does not get the benefit of a higher stock price. So if you're locking up crypto and you're getting a yield, they're paying you in coins, and the coins go up, it's a better deal, if you will, than if you had apples to apples, a stock bought at the same price, cost the same amount of money, went up just as much as the coin, but the stock's just going to give you, in our example, that $100, whereas in this example, you're going to end up with something, a coin worth 1,000. So what's the difference? The difference is, quite simply, because of the way the yield is calculated, with stock, you do not get the value of a rising share price in the yield. Of course, you get it in the value of your stock because it's going up. With crypto, you get the value of the coins going up, just like a stock, but you also get the value of the coin price going up in your yield. So I hope that explains the difference between cash, stocks, and coins and what a yield means, because it's very different in each one and how they calculate it, what you get in return, and whether or not you get to partake in the increasing value through the yield. I hope that made sense. I appreciate any comments you may have. I'll get back to them as soon as possible. Please do subscribe, and I always appreciate a like. It helps the channel and it helps push it out to more people. Thanks for watching.
Click the next video to learn 3 ways to buy Bitcoin or any other crypto.